The world woke up to a shockwave that no one saw coming. Mark Carney made a decision that could redefine the balance of power in North American trade. Markets froze. Investors scrambled. Donald Trump was blindsided by a bold maneuver that cut off a major U.S. trade lifeline at the worst possible moment. What had once seemed like political brinkmanship suddenly became a full-scale economic earthquake. The numbers turned red within minutes. Futures plunged. Currency traders braced for impact. Behind closed doors, officials on both sides of the border realized this was no routine dispute. This was something far bigger. Before we break down how this unfolded and what it means for the global economy, make sure you hit that like button and subscribe to the channel. These high-stakes political and financial showdowns are changing the world in real time. And you won't want to miss what happens next. It began with a statement that seemed measured, almost calm. Carney, known for his steady demeanor and deep experience, delivered his message without theatrics. But the substance was explosive. Canada would be suspending a critical trade channel that U.S. industries had quietly come to rely on for years. This wasn't symbolic. This wasn't a minor tariff tweak. This was a strategic choke point, a lever that had long been underestimated in Washington. For decades, the economic relationship between the United States and Canada has been described as unshakable. Billions of dollars in goods cross the border daily. Energy flows south. Manufactured products move north. Supply chains intertwine so tightly that disentangling them seems almost impossible. But Carney's move proved something else. Interdependence can be weaponized. Trump, who built much of his political brand on renegotiating trade deals and projecting economic dominance, suddenly found himself reacting rather than dictating. Sources close to the situation described a scramble inside policy circles. Advisors debated retaliation. Markets demanded clarity. Business leaders pleaded for stability. But the damage, at least in the short term, was already unfolding. The lifeline in question wasn't just about dollars and cents. It was about timing. The U.S. economy had been navigating fragile ground. Inflation pressures, interest rate uncertainty, election year volatility. Cutting off a key trade artery at this moment amplified every vulnerability. Key sectors felt the hit immediately. Energy prices flickered upward. Manufacturing stocks dipped sharply. Logistics companies warned of bottlenecks. That could ripple through supply chains within days. Across the Atlantic, European markets opened lower in response. Asian exchanges followed suit. Analysts used words like unexpected escalation and systemic risk. Currency markets saw a surge in volatility as traders sought safe haven assets. Gold ticked up. The dollar wavered. The Canadian dollar swung wildly before stabilizing under heavy intervention signals. The political dimension made it even more combustible. Trump's allies framed the move as economic aggression. Critics argued it was the predictable consequence of confrontational trade tactics. Carney's supporters called it a calculated defense of national interests. In Ottawa, officials insisted the decision was about long-term sovereignty and economic security. In Washington, the tone was sharper. Words like unacceptable and retaliatory measures began surfacing in briefings. Behind the scenes, corporate executives dialed into emergency calls. Auto manufacturers warned that assembly lines could slow within weeks. If cross-border components stalled, energy traders recalculated forecasts. Agricultural exporters feared spoilage and backlog. Even tech firms, often insulated from traditional trade disputes, watched carefully as semiconductor and rare materials supply chains showed early signs of strain. What stunned observers most was the precision. This wasn't a broad-based embargo. It was targeted, strategic, designed to maximize leverage while minimizing collateral damage at home. Carney, with his background in central banking and global finance, understood pressure points. He knew which valves to tighten, and he knew the psychological effect of acting decisively. Trump responded publicly with characteristic force. He vowed to protect American workers. He hinted at countermeasures that could dwarf the original action. Supporters rallied, praising his tough stance. But financial markets don't trade on rhetoric alone. They trade on risk. And the perception of escalating cross-border conflict injected uncertainty at a scale investors despise. In the hours following the announcement, trading volumes surged. Hedge funds repositioned. Pension funds hedged exposure. Retail investors watched in disbelief as familiar blue-chip names swung unpredictably. News networks rolled out panels of economists trying to parse the deeper implications. Was this a negotiating tactic, a long-term shift, or the opening salvo in a broader economic standoff? Global institutions weighed in cautiously. Officials from international trade bodies urged dialogue. Central bankers signaled readiness to stabilize markets if necessary. But there was an undercurrent of concern that extended beyond North America. If two of the world's closest trading partners could weaponize economic interdependence so abruptly, what did that mean for global stability? The energy sector stood at the heart of the drama. Cross-border energy flows have long acted as a stabilizing force between the two nations. Pipelines, grid connections, and joint infrastructure projects represent decades of cooperation. Interruptions in that ecosystem reverberate quickly. Energy-intensive industries braced for rising costs. Consumers feared price spikes at the pump. Strategic reserves became part of the conversation almost instantly. Meanwhile, small businesses felt the psychological shock even before the tangible effects. Importers paused orders. Exporters questioned contracts. Freight companies revised projections. The fear wasn't just about today's losses. It was about tomorrow's unpredictability. Markets can absorb bad news. What they struggle with is not knowing what comes next. Carney's gamble hinged on leverage. Canada's economy is smaller than that of the United States, but its resources and geographic position provide outsized influence in specific sectors. By targeting a critical node, he demonstrated that size alone does not determine power. Strategy does, timing does, and in that moment, he held the initiative. Trump's counter-strategy remained uncertain. Retaliation risked escalating the dispute into a full trade war. Restraint risked appearing weak. Political advisors weighed domestic optics against global consequences. Every move would be scrutinized not just by voters, but by bond markets, currency traders, and foreign governments, calculating their own positions. As the days unfolded, negotiations were rumored but not confirmed. Diplomatic channels buzzed quietly. Industry lobbyists pressed for compromise. Public statements remained guarded, sometimes contradictory. The absence of clarity prolonged volatility. Each headline triggered fresh swings in equities and commodities. International observers began asking a broader question. Was this a preview of a new era? In global economics, one where supply chains are no longer assumed safe, where alliances can fracture overnight, where economic security trumps efficiency. The pandemic had already exposed vulnerabilities. This confrontation reinforced them. Investors recalibrated their assumptions about North American stability. Risk premiums ticked upward. Insurance costs adjusted. Analysts revised growth forecasts downward, at least temporarily. The ripple effect touched emerging markets, reliant on North American demand. Even distant economies felt the chill as global trade sentiment weakened. For ordinary citizens, the drama translated into anxiety. Retirement accounts fluctuated. Business owners postponed expansion plans. Workers worried about layoffs if production slowed. Economic headlines, often abstract, suddenly felt personal. The interconnectedness of modern commerce meant that a decision in Ottawa could alter paychecks in Ohio, savings in California, and investment portfolios in London. Yet, amid the turbulence, some saw opportunity. Domestic producers in certain industries anticipated reduced competition. Alternative trade partners explored openings to fill gaps. Supply chain diversification accelerated as companies sought resilience over efficiency. Disruption, while painful, often seeds transformation. Carney's defenders argued that asserting economic sovereignty was necessary in a world of shifting power dynamics. Trump's supporters insisted that strong retaliation would restore balance. Both narratives resonated with different audiences. But markets remained agnostic to ideology. They reacted to data, to flows, to probabilities. As negotiations intensified behind closed doors, the public chess match continued. Statements were parsed for tone, body language analyzed, timelines speculated upon. Every rumor moved billions of dollars in value within seconds. The digital age amplified every tremor. What made this episode historic was not just the immediate financial shock, but the symbolism. Two nations with one of the deepest economic partnerships on Earth had tested the limits of interdependence. The assumption that proximity guarantees harmony had been challenged. Weeks later, even if compromises emerge and trade channels reopen, the memory of this rupture will linger. Corporations will diversify suppliers. Governments will reassess strategic vulnerabilities. Investors will price in political risk more aggressively. The global economy will not forget how quickly stability can unravel. Trump, known for turning confrontation into political theater, may yet reframe the narrative to his advantage. Carney, disciplined and methodical, may leverage the outcome to strengthen his domestic standing. But beyond personalities lies a structural shift, the recognition that trade lifelines are also pressure points. Markets eventually stabilize. They always do, but scars remain. Risk models adapt, alliances evolve, and leaders learn or fail to learn from the brink. In the end, this was more than a clash of egos or policies. It was a reminder that economic power is dynamic, that leverage can come from unexpected directions. That confidence can evaporate in a single announcement. And that in a world built on complex interdependence, decisive moves carry global consequences. The shock that began with one calculated decision rippled outward, shaking assumptions, testing alliances, and forcing a reckoning about the fragility of modern trade. Whether this moment becomes a footnote in a prolonged negotiation or the spark of a broader realignment will depend on what happens next. But one thing is certain. The day Carney cut off that major U.S. trade lifeline, the world was reminded that economic gravity can shift without warning. And when it does, everyone feels the tremor.